Hey guys, welcome back to Zach Going Fire. If you're new to the channel, I'm a truck driver who went bankrupt in 2016, and after getting on the route to financial freedom, I plan to retire next year at 44. Today we're diving into why buying individual stocks could stall your financial independence journey. If you've ever thought about picking stocks like Tesla or Nvidia to speed up your FIRE journey, this video might save you from some costly mistakes. Stick around to the end and I'll let you know what I consider to be a few exceptions to this rule. Let's keep driving toward financial freedom. Okay, so the first thing that I want to go over is risk versus reward. You're going to hear me going back to this a lot. Basically, everything that has to do with investing boils down to your risk versus your reward. Now, it's not just the amount of money that you put into something and how much money you can get back in return for your investment. It's also about the amount of time and effort you put into it. How much mental capacity does it take to do all of the research and stay on top of the news, the up-to-date information about the stocks that you're interested in investing in? Now, believe me, I get the draw. As a young man, I was really interested in trying to pick my own individual stocks to invest in. And you'll see thousands and thousands of YouTubers and gurus out there telling you how they pick their stock portfolio and which stocks have helped them make money. And yes, you can make money doing it. Don't get me wrong. But you're just playing with luck. Because most professionals who you're going to be going up against, professionals that do this full time, most of them actually lose to an index fund over time. In fact, many studies show that approximately 80% each year lose to an index fund. And if you look at 10 years or more, 20 years, you're looking at over 99% of active stock pickers losing to index funds. But yes, as a young man, I did invest in individual stocks. As an investment advisor, I learned about how to research all of the fundamentals. I looked at the charts and I studied the graphs, how to read the technicals, the simple moving averages. Some people invest with just using the charts, and some people invest with just the fundamentals, like the price to sales ratio and how much the profit is growing quarter after quarter, year after year. You can spend hours and hours and hours researching stocks. But in the end, you really have to think about, is that time worth it? Because you're going up against professionals who are doing the same thing. And again, most of them are no better at picking stocks than just you buying the index. One of the advantages of buying an index or an ETF that owns an index is that as a stock goes up in value, it gets more and more a bigger portion of that index as it goes up. So you don't have to worry about picking the winners. It's going to automatically grow with the winners inside of the index. And if there's a company or stock that drops and goes out of business, then that company will get kicked out of the index. So it's self-cleansing in that way. But there is definitely a thrill of thinking that you are smart enough to pick the right stocks and know when to sell and when to buy. If you do decide to buy individual stocks, then you'll soon learn that you have to decide whether you're going to buy large stocks or large companies, or small stocks, small companies, or medium, or a mix of all of those. There's a risk reward difference in those. Obviously, if you're wanting more reward, then you're going to look towards a stock that moves up or down more over time. Those are going to be your smaller companies. So you might think you can get an edge over the market by doing the research on those small companies that fewer people know about, fewer people watch, and so you can buy one of those stocks, their prices are going to move faster. So you have a higher potential reward available to you. If you buy a small stock at say $1 and it shoots up to $10, well, you've got a tenfold increase on your investment. The downside though is that there's not much information on those small stocks compared with all of the information available on the larger companies like your Bank of Americas, your Walmarts, the companies that everyone knows the name of. So that lack of information is also going to be a higher risk. Those smaller companies, they might lose a court lawsuit and lose their patent, or the one person in the company that knows how to make everything work retires. And there's all sorts of risks involved. That $1 that you think that was a low risk, that could drop down to being worth 10 cents or a nickel. And then your investment has gone down by 90% or 99%. So that's, again, going back to the risk reward. You on the other hand, you could look at the larger companies that, there are safer investments. Everyone knows more about those, and so there's more research available. They're not going to drop the same, but they're also not going to pop up the same in value. So like your Walmart, for example, you might research that. There's tons of information you can look into about all of the different fundamentals on those larger companies. But the thing is, everyone else is also has that information available at their fingertips, because not only are you going up against the professionals who are professional analysts and do this for a living, you're also going up against company insiders. This goes for both large cap and small cap stocks or medium cap stocks. And I'm about to tell you two stories about when I used to trade individual stocks, about how I've learned my lessons on how some of this works. So way back about 15 years ago, when I first started investing in stocks myself and I wanted to buy individual stocks, in the beginning I only bought the larger companies like your Bank of Americas and your Walmarts. And I did lots of research trying to figure out how to buy, when to buy, how much to buy. And most of my investments made money during that time. The more I did it though, the more I was realizing that the larger the company that you buy, the more that investment basically is going to match the return of the large index funds like your S&P 500. So like if you spend a lot of time researching Bank of America or Google or Apple, and you decided to buy some of each of those companies, and your investment in turn, after let's say after a year it goes up by 10%, and you think that you've done great with your portfolio of your basket of larger companies, earning that 10% in a year. But then you look at the return of the index fund, and lo and behold, it's about 10% as well. So you have to think, was it really worth it for all of that time and effort you put into building your portfolio of larger cap stocks just to get the same return as the index? So eventually I looked into some of the smaller companies that I thought I could get an edge on by investing in those. So one company I looked into, and I won't say the name of the company. This was a long time ago. I don't even know if this company is still in business. But at the time, they were saying that they had the technology available to sell the first solid state hard drives to the commercial market. They were saying that their competitors were about 2 to 3 years behind where they were in being able to produce enough solid state hard drives to sell to the commercial market and get it out there to like in computers and like Walmart. So the stock price had been falling, and I bought some of it. I didn't put a lot of money into it, but I put some money into it, about $1,000, which back then that was a lot of money for me. So about as soon as I listened to their conference call and I invested about $1,000 into their stock, it seemed like it was about the next day when information came out that overnight that their stock price plummeted. It went down about 30 or 40% overnight, which, I mean, that's not really going to happen with one of the larger companies out there. But, this was a smaller company. And so I looked at what was going on. I had to look into this. How did my investment drop by like 30 or 40% overnight? And it turns out that the executives had been lying. They knew that other companies were close to being able to produce these solid state drives, and they were actually selling their stock that day after they had done their conference call, claiming that they were 2 or 3 years ahead of the nearest competitors. I went ahead and sold my stock then as well. The stock never really recovered, and long story short, that's how you know that these guys, you can't trust what these executives are saying on their conference calls. They were never really held accountable, even though what they did was morally wrong, lying about that, because you can't prove, or at least in that situation, you couldn't prove that they knew that the competitors were close to being able to produce those. So they walked away after selling. They left the company and left me and thousands of other investors on the line with major losses. So that was story number one. The second example of me trying to invest in a smaller company to make some extra money, I spent a lot of time researching an offshore drilling company. They were looking into drilling for oil in one of those offshore locations. They had actually many locations, and they had many more contracts that they were about to open. So this was back when oil prices had been going up, and with them being able to open up several drills offshore, and they had many more contracts in the wings in the next few years, I thought this was a great opportunity. All of their fundamentals looked great. I thought I was going to make tons of profit with this investment. So I put about $1,000 into their stock, and once again, it seemed like it was about the next day that oil prices dropped. So there was like no way for me to know that oil prices were going to drop. They lost a lot of their contracts right away, and their stock price dropped by about 20% overnight. The reason at the time that oil prices were dropping so much is that we had found all of that new shale oil, and new companies were coming online that were able to produce the shale oil cheaper. And well, maybe I could have known that if I was more of an industry insider, but I'm not an industry insider. But there's always someone out there that knows things about things going on in the world that we can't know sitting at our computers trying to research. And that's definitely not something that I want to spend time doing in my retirement. So that was story number two. So here's a big thing about whether you should buy individual stocks. Whether you're buying stocks, real estate, or any asset, you really need a complete plan. So most of the time when you look online and read about gurus and YouTubers talking about buying individual stocks, they're only talking about the exciting part of the buy. They're not talking about the sell. And also part of a complete plan is not only that when you should buy or when you should sell, but how much of something you should buy or sell. That's really important to know. So when you look at, for example, J.L. Collins with his book, The Simple Path to Wealth, I would consider his about as full of a plan as you could get. He talks about buying index funds. And if you read the book, he doesn't talk about being 100% in stocks all the time. He talks about a plan to when you should be more in bonds. And he really doesn't advocate buying real estate as an investment. However, I do see you can definitely make the case to buy real estate and go into rental properties and things like that. If you want to do that as your FIRE plan, I can definitely see the case for that instead of stocks. However, whether you do that or index funds or individual stocks, you're going to need to know how much to buy, when to buy it, and how much to sell and when to sell it. That's why I follow Jason Kelly's signal plans to manage my entire portfolio. So I've chosen to follow and rely on stocks and not real estate because to me that's just simpler. However, let me just also say that stocks over the long term have the highest return. That beats out real estate, gold, everything else over the long run. But real estate you can get the performance of real estate in stocks if you use leverage. For example, when you take out a mortgage on a property, which is how a lot of people are able to retire with real estate investing, just like you can with stocks, or you can use a mix of the two. But in either case, you need a full, complete plan of when to buy, when to sell, how much to buy, and how much to sell. And that's what Jason Kelly's signal plans do for me. They give me like a roadmap telling me exactly when to do it. And in the interim, once I've made my decision with the plan at point A, at the end of the quarter, beginning of the quarter, I don't need to look at the roadmap again until the end of the next quarter. Whereas if you're buying individual stocks, you need to constantly stay up to date on whether or not that stock is going to stay in business or continue to grow their profits. Unless, of course, you buy one of the larger companies, in which case, again, you're not going to get a big difference in performance over what you would get with just buying an index itself and holding, like you can with The Simple Path to Wealth in J.L. Collins' book. As promised, let me go over some of the exceptions to buying individual stocks. So if you are really enamored with a certain company and you have a gut feeling that that company will skyrocket in the future, then by all means buy some of that company's stock. I wouldn't recommend putting more than 5 or 10% of your portfolio into a single stock, but that's not for me for sure. Also, if you really just enjoy spending your time researching and listening to the company corporate quarterly calls, then spend your time doing that. By all means, do that and manage a portfolio of stocks. My guess is that your performance wouldn't be much different than just owning the index. So you have to ask yourself if that's worth it. We decided to buy one individual stock in our portfolio. We bought Carnival. And the reason is because we enjoy going on cruises. So after the pandemic, all of the travel stocks had crashed, and we knew that we enjoyed cruising. Carnival stock had gone down to around just over $6. And we knew that we could buy 100 shares for around $6, which you need 100 shares to get the discount for going on cruises with Carnival. So that's what we decided to do. We scooped up 100 shares when they were cheap, and we knew that we could use those to get our discount. And we thought of that investment not so much as an investment on the stock itself, but as an investment in our future. We figured that even if the $600 in stock went down, we weren't going to sell it, we weren't going to buy more of it, we were just going to hold. And even if it dropped down to $0, we would still be able to, after about 6 cruises, make up for the cost of that investment. And that investment has paid off very nicely. Now it's up over around 300% since we put the money in, and we've gone on several cruises and used the $100 off each cruise. So that's the one exception that we use, and again, then an exception that I would not speak too negatively on you if you bought something that you really believed in. So that's it for today. Please let me know in the comments what individual stocks you own. Let me know if you have any questions or comments about the trades that I told you about, or if you have any more questions about using Jason Kelly's signal plans. Until next time, guys, let's continue to drive towards financial freedom.